Can you explain the moves that we've been seeing in the Treasury space over the last few weeks here, Ed?
Yeah, a little bit of all of the above. I think the culprits you named are probably exactly right, right? The data is surprised to the upside relative to what the Fed had going into the September FOMC. The fact that the Fed led with a 50 basis point move means that they've put a floor under the probability of a recession next year. And, the election on the margin perhaps has had, some impact in terms of positioning. I don't put a lot of weight on the election, particularly if you look at the last couple of weeks. The election's been a coin toss, and those probabilities, in my mind, haven't really meaningfully moved.
So you're not going to be sitting on your couch on November 5th with your spreadsheets open, your notebook out, taking notes here on what's transpiring? It does not matter enough to you to do that?
I think the outcome of the elections is going to be important. Am I going to be sweating it the night of the election? I hope not. I pray that I won't be.
What will you be watching for on the night of the election, Ed? Are you going to be looking at, U.S. Treasury futures or copper or the peso?
I think if you're tracking the impact of the election as the results come in, as you're tracking that, the impact on markets, I think currency markets, particularly currency markets overnight, are going to be the most liquid and perhaps the strongest signal. I will be watching for strength in the dollar, particularly versus the euro and emerging market currencies like the Mexican peso as a first reaction, particularly if the results start to indicate that Republicans are likely to take the White House and control of Congress. The opposite if there is a Democratic sweep.
All right. Thank you for answering that. I want to go back to Treasuries for a moment here, because even if we chalk it up to the better U.S. economy, the election seems to be having an impact in terms of volatility. You look at the MOVE index, and there's been a tick up in the U.S. Treasury volatility index in the lead up to the election. And it happened in the last round as well, right, in 2020 and in 2016. How much positioning do you think there is going on in terms of just people trying to trade off the volatility, the expected volatility that we tend to get before an election?
Yeah, a little bit. You see volatility, particularly near-term volatility, being bid up across the board, across asset classes. That's consistent with people trying to square up positions going into the election. If you take a step back, volatility in rates is also up because the Fed and the combination of data that we've had over the course of the past couple of months have injected some uncertainty in terms of where the Fed is going to land. What the Fed's terminal rate is, if you will, at some point next summer. Is it 3.5%, 4%? That range has broadened out as data has come in. And so the volatility is in some ways reflecting that. I'll also point out that in my mind, the pricing of volatility has consistently overshot what volatility we've realized in the rates market. And so in my mind, it's likely that volatility is a little bit on the rich side at the moment.
Give us a sense here, Ed, when we start to talk about the idea of repositioning largely around the expectations of what the Fed is going to do, and now the presumption here that we are at least going to be in relatively stable economic conditions. And yet, Ed, we have not seen a full-on embrace of longer duration in a way that I think people thought we would have. Is this sort of a trade that's delayed, or is there a reason why people are a little bit too reticent to do that?
It's a combination of a couple of things. One, the starting level of yields across the fixed income space is very attractive. And I think that's a significant differentiator in terms of this cycle versus, let's say, the 2018-2019 cycle. So if people have stayed in the front part of the curve, of the Treasury curve, for much longer, it makes sense. The Treasury curve just recently flipped from being inverted to being positively sloping. So the yield advantage of going out onto the further portion of the curve, let's say the 10-year yield, 30-year yield portion of the curve, that yield advantage has been relatively modest. And so the case for long duration was really built on data weakening, particularly in the labor market. That's taken a back seat in the course of the past 2 to 3 weeks. But that case isn't closed. The fact that we have a stable labor market, and perhaps a labor market that's even improving, I don't think that's been proved by the data, at least not yet.